Good afternoon, and thank you for joining today's webinar. We're happy to have TechMet and the Palm Beach Hedge Fund Association for today's event, Investing in Metals to Fuel the Technology of the Future. Before I introduce our main speaker, Brian, I'd just like to point out a couple of things. I'm John Jannerone, the Editor-in-Chief of IPO Edge, and if you have any questions that you'd like to submit to Brian, please send them directly to me at editor@ipo-edge.com, or you can use the Zoom portal. And also, if you'd like to reach out to the company directly to find out more about the offering itself, please email Henry Finnegan at henry.finnegan@techmet.ie. And before we get Brian live, I'll introduce him briefly. So Brian has a quarter century of experience in the natural resources industry, working in projects across 18 sub-Saharan countries, the CIS and Canada. His family company, the Angloval Group, has been an important player in the African mining and industrial scene for 80 years. Prior to this, he was the CEO of the TechMet Group, and he also has background at De Beers, and before that, he graduated from the University of Pennsylvania. So with that, I will begin the presentation with Brian. So Brian, thanks for joining today. If you could tell us a little bit about TechMet and what the company's strategy is, and then we'll get into some more details.
Thanks, John. It's a pleasure to be with you. John, TechMet is a private company in which we're building a portfolio of projects that produce or process or recycle what we call technology metals. And technology metals are the key ingredients of batteries, electric vehicles, renewable energy systems. The inputs into the power, energy, mobility revolution that is now underway and is unstoppable and inescapable. So why we're doing what we're doing in TechMet is for three primary reasons. One is there's a massive supply-demand dislocation that we're at the beginning of for these metals between exponential growth and demand driven by electric vehicles and other systems, and a structural short supply of the key inputs, or at least an inefficient scalability of the sources of supply. So this is really an epic zone of value creation opportunity for these strategic metals and metal chemicals. The second driver arises out of the extent to which over the last 15 years, China has secured a dominant position across all of these strategic materials to a point where today they control between 65 and 95% of the global markets for all of our products, which is a major geopolitical and obviously national security issue in the US, Japan, and Europe. Which is one that differentiates us from a lot of our industry because we are entirely independent of Chinese funding or influence or partnerships. The third driver is our very high social and environmental impact governance standards, which are crucial to this category of materials that come from sources of origin through a pipeline of value to consumer goods.
Great. Can you tell me a little bit about your assumptions about the metals that you're going to be producing? Is it easy to forecast the future market prices, and how robust is your forecasting?
We in TechMet produce, process, or recycle 7 metals or metal categories: lithium, cobalt, rare earth metals, tin, tungsten, vanadium, and nickel. These are the metals where we see the most severe supply-demand dislocation going forward. And this shortage of supply is really very, very severe. If you just look at electric vehicles as one of the demand drivers, even if the 7 million electric vehicles in the world today only goes to 100 million in 10 years' time, which is below the bottom of the most pessimistic forecasts, much more likely to be 150 or 200 or 300 million. But in the event of a downside scenario of ongoing global recessionary environment, escalating trade conflict, and other downside factors, and it only goes from 7 to 100, this still requires 3 times the present total global supply of cobalt, 5 times the present total global supply of lithium, and 12 times the present total global supply of battery nickel. And that's a more severe dislocation of supply and demand than anything in natural resources that we've seen since the impact of the Industrial Revolution on for coal and iron ore. And it will require 3, 4, 5 times the present prices for these metals to stimulate the supply to meet the demand growth, which even in a coronavirus depressed environment is unstoppable and inescapable. You know, a depressed 1, 2, 3 years of global economic growth is not going to stop the transition to electric vehicles, renewable energy. It might slow it somewhat in the short term, but it doesn't change the picture. So all of our metal supply demand models, which we have and have built and developed and continue to update and refine, are really inescapably compelling for all of our products.
That's great. So just to clarify, and there might be some viewers who are not familiar with technology metals, but are familiar with precious metals, this is very different from forecasting the price of something like gold or silver or platinum, because there's real industrial demand for it, right?
Yeah, all the demand for our metals are technologies that are in existence, are being produced and are being scaled and growing to dominate the global landscape in power, energy, and mobility. So this really is one of the area of demand that we're selling into is one of the defining areas of global industrial and technological evolution. And really the ingredients we're producing are the ingredients that make a clean, renewable energy, sustainable world possible.
Great. Now, are there any longer term targets or business plans that we should talk about? You know, it sounds like these metals could be put to use right away in some of these electronic vehicles, but are there some longer term plans we should discuss too for investors who are looking at the business?
I think, you know, what we're doing to produce, process, and recycle these metals is selling into a market that's in its infancy and is evolving very, very rapidly. So, you know, our longer term vision is obviously to continue to scale production and processing and recycling of our metals and metal chemicals as the electric vehicle industry comes to dominate automotive, as renewable energy industry and hence the on-grid and off-grid battery storage requirements to facilitate the next phase of renewable energy continue to scale. And it's really, you know, limitless. I mean, if you just look at lithium-ion batteries, today there's over $60 billion of capital committed to developing additional lithium-ion battery manufacturing capacity in the next 18 months. You know, it's accelerating very, very quickly, and the ingredients are in short supply and are controlled by the Chinese. So the big picture macro tailwind is completely overwhelming and inescapable for what we're doing.
Okay, great. Let's move on to another subject to look at the assets. Just quickly here, this is some interesting data. We all can tell just by paying attention to the news that electronic vehicles have been a big part of the conversation in the investment community, but you can see the data here from Sentio, which tracks this, just showing the explosion that's occurred here. Let's move on and talk a little bit more about the assets. So can you tell us just a bit about how you divide the businesses? Because there are 5 assets, if I remember correctly. You know, between producing, refining, and recycling, is that poised to change?
Yeah, our intention from the outset, since we began to build TechMet in its present form 3 years ago, has been to have a fairly equal mix of value across the middle portion of the value pipeline for our metals and metal chemicals. So approximately a third production, a third processing, and a third recycling. And that's reflected in our present portfolio of our 5 initial projects and companies, which we're busy investing in now, and which make up all of the use of proceeds of the round 2 funding that we're presently halfway through, with a target of $80 million, all going into the priority projects within our existing portfolio. The lithium-ion battery recycling, nickel in Canada and the US, our nickel cobalt production in Brazil, our tin and tungsten mines in Rwanda, our rare earth strategy with production out of Burundi, processing in the US, and our vanadium specialty chemicals plant in the US here in Arkansas.
Okay, great. Can we talk a bit about those assets for a moment? How many of them are producing, and the ones that aren't yet, how soon do you expect them to be delivering revenue and cash flow? Is that in the near term?
Perhaps, John, if you could put up the slide of our TechMet assets, that would be helpful. But we are, I think that's slide 3.
Oh, here.
Great. So approximately half of our present projects are producing. Our tin and tungsten mines in Rwanda are producing and cash generative. We're funding the fairly substantial expansion of the capacity of those mines over the next 18 months. In fact, more than 4 times production over that time frame. But they have been producing mines for many, many years. Our vanadium specialty chemicals plant in Arkansas that we're building a dominant position in as we continue to participate in their expansion funding, is producing, is cash generative. It takes various waste products, fly ash, smelter slag from steel mills, catalytic residue, and is the lowest cost producer in the world of vanadium pentoxide, which is the primary feed for vanadium redox flow batteries, which we believe will be one of the winners in the grid scale battery storage competition. Our lithium-ion battery recycling company, Canadian company, which we've been the primary funders of for the last 2 years, is in production, producing, selling an intermediate product out of our facilities in Kingston, Ontario. We're in construction for the first US plant in Rochester, New York, which will do 5,000 tons of battery input a year, and will be significantly, by a significant margin, the biggest recycler of lithium-ion batteries in North America. And that'll start commissioning in September and be fully ramped up by November, December. Our nickel cobalt project in Brazil has a producing pilot plant, but we're commencing development of the first commercial plant within the next 90 days, which will be in production in 12 months' time. The rare earth strategy to develop processing capacity in the US is in pre-feasibility, so that's a little bit further away. But we're not in an early stage exploration of project development business. We're in the business of either expanding existing projects with existing revenues, or developing late stage development projects through to positive cash flows within an 18, 24 month time frame.
Great. And just going back to this here, when you think about acquiring additional assets, what might they look like? Would they? It sounds like you're not interested in buying unproven mine assets or anything like that. So you would intend to purchase assets that are already at or near positive cash flow?
Yeah. No, we would, and that has been the case up till now, and will continue to be. We, as I mentioned, all of the use of proceeds of the money we're raising now is our existing projects. However, beyond that, we would like to add to our portfolio, and we've done a lot of work on a number of other projects across that middle portion of the value pipeline, including some lithium processing technologies, some further vanadium projects that would provide feed to our plant in Arkansas, and another number of other initiatives, all in low risk environments. We're again not in the business of speculating in politically risky or unstable environments such as the Congo for cobalt, where there are great opportunities, but we have chosen to put together a fairly blue chip, low risk portfolio of projects, both in terms of counterparties, management capacity and expertise, and jurisdictions. And that's what we'll continue to do as we scale our platform. And we have got a very scalable platform. We've got a very strong team. We've got very strong projects, strong counterparties. So we would like to deploy more capital beyond our present raising, but obviously only if we can raise and deploy in a manner which continues to add a lot of additional value to our shareholders.
Now, are there some countries where you are operating where there are risks, but you've decided that they're manageable, and how do you look at them? I mean, there's political risk in some of these countries, Brazil, Rwanda, and for that matter, there's also been things like coronavirus happening. I mean, how do you manage that, and does it pose any threat to your forecasts?
Yeah, I mean, to your first question, our value is very heavily weighted towards United States, Canada, and Europe, which are obviously low-risk environments. Our biggest project outside of those jurisdictions is our nickel cobalt project in Brazil. Brazil is a very well-established mining jurisdiction from a regulatory and administrative and enforcement point of view, and therefore one in which we feel very comfortable. We've known the country and worked there in other contexts over the years. We're partnering with a very, very strong technical and management team in Brazil. Our only exposure in Africa, or only substantial exposure, is our tin and tungsten mines in Rwanda. And again, Rwanda is in African and emerging market terms generally considered very low risk, very well governed, efficient, organized, low level of corruption. So we're very comfortable with Rwanda medium long term with respect to our exposure. And we'll continue to work in low risk environments, as I mentioned. From a coronavirus point of view, obviously the disruption that the world is suffering is not one we're immune from with respect to short-term impact on metals markets and the ability to develop, transact, and travel, and obviously, and therefore operate efficiently. However, we are very fortunate and very well placed in the context of the present crisis in terms of the extent to which we are going to come out of it much stronger than we went in, for three reasons, I guess. One is we're very well positioned as a China fee producer of these materials, and the counter-China sentiments in the Western markets has grown considerably in this present crisis, and I don't think that'll be reversed. The sense of urgency with respect to diversifying away from reliance on China for supply lines of strategic materials is growing, and we are benefiting from that in terms of funding and political support in Washington and Tokyo, which is important to us. A lot of the stimulus money that's going in to repair the damage of the present crisis, particularly in Europe, is going into clean technologies, energy transition, electric vehicle industry, which will hasten the growth in the demand drivers for our metals. And a lot of the sources of, or a lot of new projects that are required to supply these metals are being delayed or cancelled as a result of the present funding environment, particularly those in the hands of listed companies. So the shortages 2, 3, 4 years out will be even greater than they would have been without a period of disruption. So we are very fortunate, you know, nobody's fortunate in the present crisis in the big picture, but we are very well positioned to do well out of it rather than be damaged by it. All of our projects are sound, operating, in good shape. Fortunately, minimum disruption and minimum impact to value at the project level across our portfolio.
Okay, great. If we might move on to the fundraise itself, can you give us a quick overview of what you're looking to do here, and explain the structure? You know, are we investing in a parent company, and what sort of ticket size are you looking for from investors?
Sure, John. If you want to put up the first slide, just the sort of summary slide of the company, which by way of illustration, we're a private company domiciled in Ireland. We've got one class of shares. There's no management fees or high voting shares. So it's a very clean, simple structure. People investing in our round 2 funding, of which we've already closed 20 million and are busy closing a further 25 million with the US government agency, giving us 35 million still to run to complete our target for this round. Those participating get ordinary shares, just like my shares, with no, you know, a difference of economics or rights. So we've kept it very simple in order to fund smoothly and in order to maximize our flexibility to build and crystallize and extract value for our shareholders over the next 3, 4, 5-year horizon, with maximum optionality with respect to IPO, spin-off, sale, IPO of underlying operating companies, as this very exciting arena in which we're operating continues to evolve monthly and yearly as we go forward. And the audience for what we're doing continues to grow rapidly. You know, there is a growing appreciation on the part of sovereign structures, big private equity markets, you know, of this epic supply-demand dislocation that we're in the middle of.
Okay, great. Let me just return to this slide here for a moment. What do you think about $80 million given the size of the opportunity? I mean, there's an immense amount of technology metals out there that you could be extracting, producing, recycling. Is that a number that makes sense for now? And are you thinking about raising more later, or is the company going to be generating enough cash it won't be necessary?
The 80 we're raising now gets us to very significant positive cash flows across all of our portfolio. So beyond it, we could choose to grow organically, or we could choose to deploy another 200, 300, 400 million, which we certainly have the capacity to deploy over the next 3-4 years to build multiple billion dollars of value, as opposed to the $1 billion of value that we see clear line of sight to with our existing portfolio and our existing use of proceeds over the next 4 or 5 years. So that's really a product of our judgment, our shareholders' judgment, our board's judgment with respect to how we optimize shareholder value and route to liquidity over the next 1, 2, 3, 4, 5 years. Obviously, I would personally love to build a $10 billion technology metals company, having deployed $500 million, $1 billion over the next 3-4 years. And that's certainly the scale of opportunity in our space and with our team, with our deal flow and expertise.
Great. I'm just going to interject here for a second. Someone in the audience has asked if there's an offering document. To get more information about that, please reach out to Henry Finnegan. So he's henry.finnegan@techmet.ie.
Sure, if you could do that, yeah. that would be great. And obviously we do have detailed investment papers on the company and all of our assets and projects and financial models, and all the underlying agreements, structures and documentation in our data room. So if any party wants to engage and sign an NDA, we've obviously got everything that you would want to see in order to understand the full detail of our present structure, value, and offering.
Great. And then just back to the fundraise. To put this in context, Brian, this seems like a sector or space that people very much want to get exposure to. But are there other ways they can do it, and what separates TechMet from the other investment possibilities out there?
That's a very good question, John, and it was one of the defining drivers of our establishment of TechMet in its present form. It's very, this is a very, very exciting and compelling space, and in my view, for an institutional investor or a family office, it's really a must-have rather than a want-to-have, because our commodities will outperform other commodities, and in our view, other asset classes by multiples over the next 2, 5, 10 years, because the supply-demand dislocation is so compelling and epic and inescapable. And it's a difficult space to invest in. You can't really get exposure through physical and futures of the metals, because most of our metals are illiquid and not terminally tradable and not transparent markets. There are exceptions: tin, nickel, you can to an extent, cobalt, lithium. There's certain products being developed but immature, but it's difficult. You can't synthetically put together exposure to what we are doing through our projects. You can't, the big miners, the big global natural resource mining companies aren't in our space. So you can't buy BHP, Anglo American, Rio Tinto, because they're not in technology metals, because the individual projects and markets aren't of scale to justify their focus, even though they're missing out on what will clearly be the biggest mining boom of our generation. The exception, there are a few minor exceptions, but generally the big miners aren't in our business. There are a few people talking about battery metals funds, but nothing we're aware of that's developed or mature enough of substance that you can invest in. So the investors who want to play in our space are left punting on a Canadian company with a lithium project in Argentina, or an Australian company doing dump retreatment for cobalt in the Congo, which are generally, illiquid, volatile gambling markets, generally badly managed and badly run companies, and require a skill set to assess risk and country risk, product, technology risk, team risk, that most institutions and family offices don't have the confidence they have. So we've, I think, a very unique opportunity to get exposure in a managed, balanced way across all of the key metals, key technologies, and key low-risk geographies in this, epic shortage of technology metals.
Great. Now, Brian, we talked about your resume a little bit, but can we discuss your team in a little bit more detail and what they bring to the table in terms of experience that will help you guide the company going forward?
Yeah, we have my own background. I've been in metals and mining for more than the last 25 years, including quite a number of businesses and projects in our technology metal space across Africa and elsewhere in the world. Our team at the top, we have a small team of 8 people at the senior executive of TechMet who cover all of the necessary skills in terms of technical operational project management, as well as corporate finance and deal and funding structuring. So we have a very integrated team with a lot of experience in the industry across all of the different disciplines that we need. We've got a very strong board from a governance and experience point of view of private equity and our industries, and a very strong advisory board from a geopolitical strategic point of view, which include our chairman, Admiral Mike Mullen, former chairman of the Joint Chiefs of Staff of the United States, and principal military advisor to both Bush Jr. and Obama, and since then Director of General Motors, advisor to SoftBank, Director of Sprint, Professor Vasant Kumar, one of the foremost battery chemistry researchers in the world and head of material chemistry at Cambridge University, and quite a number of others. So, I think we have a very robust and very scalable platform in terms of depth of expertise and experience.
Great.
All of whom we've known for many, many years, as have we done so with the operating teams who we're investing through and with at the subsidiary operating company level, all of whom we've known for many years and worked with over the years, and therefore have high confidence in.
Great. And just one last thing, is there anything about this moment in time that is especially appealing for potential investors? I mean, you talked about the attributes of the business, but why at this moment in time where we are in the world, is it the moment to take a look at technology metals?
The drivers of demand are accelerating. So we're at the beginning of the electric vehicle revolution. We're in the early stages of the renewable energy electrification revolution. So we really are at an inflection point where all of these systems and technologies that require these lesser known metals are accelerating. So this is the moment. This is one of those unique points in history where you have a global technological industrial transformation that needs a different set of inputs to the iron ore, manganese, aluminium, coal of previous technological and industrial revolutions. So this really is, once in 100 years, once in 200 years moment of opportunity for what we're doing.
Okay, great. Let's move on to a little discussion of geopolitics. So Brian, you mentioned that U.S. government agency, the USGFC, is close to closing on a substantial investment in the business. Does that reflect a strategic alignment with the United States government?
Yeah, from the outset, as TechMet, we have done everything to be in alignment with US interests and Japanese interests. So we've done quite a lot of work at developing a network and understanding the drivers from a national interest, national security point of view in the United States, as we have in Japan, where we also have as one of our directors a senior advisor to Prime Minister Abe in the Cabinet Office in Tokyo. So this has been important to us as a differentiator, firstly, because China is overwhelmingly dominant in our space, and we don't believe that's good for the United States, good for Europe, good for Japan, or good for the world. China's done an exceptional job, and we have enormous respect for the many Chinese state and private sector players in our industry. But for them to be as dominant as they are globally and have the power to close down the Teslas and Panasonics of this world as rapidly as they can is not healthy. I don't believe it's healthy for China, let alone for the world. I think that level of extreme dominance creates instability and is not conducive of the world that we want our children and grandchildren to grow up in. So we're committed to that. As a result of that, we are engaged, as you mentioned, with the United States International Development Funding Corporation, which we are in the process of moving towards closure on an initial $25 million equity funding structure, which will be, I believe, and we hope to close that over the summer. And that will be, I believe, the first time in history that United States government agency has held a substantial direct equity interest in a mining and metals company. And that's really driven to an extent by this national imperative to balance China's control in our space. In Japan, at an earlier stage, we're busy with JOGMEC and JBEC as Japanese government funding agencies. And this type of funding will allow us to grow bigger, quicker, and add a lot of value to our shareholders. So it is a very significant value driver. It's not only a matter of principle, it's also a matter of shareholder value.
Great. Brian, just to dig a little bit more into this, how does a company that has a need for technology metals, so say a company that's producing electric vehicles, for the battery components, do they typically have long-term contracts with individual producers, and are many of these in China? I'm just trying to get an assessment of how the metals are getting to the cars right now.
Yeah, I mean, the challenge for automakers who are busy electrifying their fleet, which all of them are, is that they don't understand the pipeline of supply. They're starting to understand it because they understand it's a key element of their sustainable competitiveness, but they've never bought cobalt or lithium chemicals, let alone manufactured cathodes or batteries or battery packs. They buy battery packs. However, the VWs of this world who've committed, I think, over $60 billion to the electrification of their fleet over the coming 3-4 years. Obviously, ones that are further down the road, like Tesla and all the others, GM, BMW, are starting to look at how they can secure preferential access to battery chemicals in competition with the Chinese in order to be sustainably competitive, and in light of the extent to which Chinese interests will advantage Chinese industry relative to those industries in Europe, Japan, and the US. So there's a growing effort to try and engage in the pipeline of supply, but it's in its infancy. So I think Tesla's started to try and look at some lithium contracts. Certainly BMW, VW are looking at some non-Chinese controlled sources of cobalt, but it's early days, but they're going to have to do a lot more work in that regard if they're going to compete and succeed in this new global auto industry that will produce possibly almost only electric vehicles in 5 to 10 years' time.
And when you're a large company that has a need for a huge amount of these components, do they typically go to several producers? I mean, how do they look at the supply line? And is it easy to be added on if someone is already working with someone else? Can you just explain the supply chain dynamics?
Yeah, they all want diversity of supply, and they all want diversity of supply that is not dominated by China, and that's a massive challenge. They all, want to secure supply on behalf of their battery manufacturing partners or suppliers. Yeah, most of these companies are not manufacturing or planning to manufacture their own batteries. They're either partnering with battery manufacturers who generally are buying from, cathode manufacturers who are buying from cathode chemical precursors. And therefore, it's a pipeline that's not easy for them to engage in, but they're having to engage in it, and they would increasingly have to engage in it. These are specialty chemicals which take time to qualify. So where we're producing, we sell into the industry, not only battery metals, we also are in the rare earth business for permanent magnets for electric motors. We're also in the tin business as a solder for all the electronic circuit boards. So we're producing and selling across the different technologies enabling this transformation. But all of them are specialty metals and chemicals, metal chemicals that require a period of qualification and testing in order to be suitable for specific manufacturers. So there are considerable barriers to entry.
Just a question about China: has there been up to date, and could there be technology metals getting tied up in a trade dispute where they would suddenly become unavailable? And is that maybe that's a simple question? It gets back to the need to not be dependent on China, but is that a real risk that suddenly that supply go away?
No, it is. I mean, China, as I say, has probably 95% control of global supply of rare earth metals and rare earth metal products. They have between 60 and 80% control of lithium, cobalt, particularly processing capacity and intermediate chemicals. And they're doing that and have done it with enormously effective strategic intent over the last 15, 20 years in order to use it. And they'll use it in two ways. One is, as I mentioned, to advantage their domestic industry in terms of competitiveness relative to industries elsewhere. So they will potentially starve or overpriced competitors to Chinese manufacturers of batteries and electric vehicles. And they also will use it as a tool in escalating global trade conflict environment, which unfortunately I think will remain a factor of the world we live in for many years and decades to come. And the competition commercially and trading wise between the US and China is certainly here to stay and will be one of the driving geopolitical features of the world we live in, for as long as we're working. And that's dangerous, and they've done it before. In 2010, when they had a territorial dispute with Japan, they cut off supply of rare earth metal products to Japanese industry. And that led to a massive boom in rare earths, which resulted in a lot of competition, which they then came back into the market to kill. So they have previously used it as a geopolitical tool, and they will, they will certainly threaten to and could do at points in the future as the global trade conflicts evolve.
A question about scale. As these, let's just say car companies, for instance, are looking to diversify their supply, are the assets that TechMet has large enough to supply a very big buyer like that? Or do you need to reach a certain scale?
We certainly are, and all of our projects are significant and scalable to be significant low-cost producers of metals and metal chemicals to these industries. So our project in Brazil, for instance, will ramp up over the next 3 years to 35,000 tons a year of nickel, 1,000 tons of cobalt, very low cost, bottom quartile cost producer of these specialty chemicals. And we actually produce nickel and cobalt chemicals that can go straight to cathode precursor manufacturers. Our recycling is world-class, best process in the world, and scaling up to be a major producer, recycler and producer of battery chemicals. Our tin and tungsten mines likewise are being expanded. So we are building very significant and material low-cost production across this portfolio of key strategic metals and metal chemicals.
Okay, great. As we continue here, we've got a couple of questions that have come in, but I want to remind the audience, please go ahead and post a question here on Zoom or send it to editor@ipo-edge.com and Brian will answer it for you. Someone's asked for you to dig a little bit more into the M&A pipeline. Is there a large pool of potential targets out there, and are there accretive deals to get done if you decide you want to expand?
There are, and in the process of building our present portfolio over the last 3 years, we've done a lot of work, I think, on about 50 projects. Obviously we've transacted with 5, which is what our portfolio to date. There are 4 or 5 still in the pipeline that we'd like to add to our portfolio over the next 1-2 years, funding willing. So there is a lot out there. There are a lot of great projects in weak hands, particularly in the present disrupted environment. In junior company hands who are not adequately efficiently saleable or fundable, and in private hands that likewise are not robust in terms of their ability to develop and fund further expansion. So there's a lot to do, and we're not, even though this is an incredibly compelling space, it's surprisingly less competitive than you'd expect. We're competing everywhere with the Chinese, but everybody wants alternatives to the Chinese, both at the producer country level and at obviously the off-taker level. The junior mid-tier listed mining world is fairly weak and fractured. There's nobody else really engaged in building as we are. So there is a lot to do, and we could certainly continue and intend to continue to acquire and develop interest in these projects with the target of being dominant participants in these projects or controlling participants, as we continue to fund and develop over the coming months and years.
Brian, are some of these potential targets in places where maybe M&A is a little bit tricky for those who don't have experience? So on the African continent, for instance, are there possible targets there? I realize there's the political risk and so on, but are there opportunities there, and would you be comfortable executing on them, given your background working in Africa?
Sure. We know and I'm very comfortable operating in all these countries, and I think can manage the risks, the environment, the logistics, the politics, as well as anybody, be it the Congo or anywhere else. However, we as TechMet have set about establishing a low-risk portfolio from a political exposure point of view, and therefore we're not pursuing opportunities in the Congo, Zimbabwe, and other high-risk countries where there are interesting opportunities, but ones that we don't want to damage our present risk weight or perceptions of risk in our present portfolio by engaging with. However, we're busy in Rwanda in discussions to merge with the second biggest mining company in Rwanda. We're the biggest mining company in Rwanda to create more critical mass and diversity and build more capacity across tin, tungsten, and potentially tantalum. We are looking at a couple of projects in West Africa in countries that we know well and are very confident we can manage, that are very interesting and synergistic with our present metals, present projects. So we're not adverse to, there are projects in Kazakhstan that are interesting that we've done work on. So we're not adverse to new geographies, but we are adverse to countries we haven't worked in before because we need to know them intimately to manage risks. And we are adverse to countries that are too considered and with some justification to be too speculative, like the Congo, where we don't intend to engage in the foreseeable future.
Great. Someone's just
I
asked.
think, John, if I could add one point, we also don't want to engage in countries where we can't maintain very high levels of social and environmental impact governance. And in some of these countries, that's a tough thing to do. We want to be in countries where we can ensure we're clean, sustainable, ethical, and well-governed.
Great. Yeah, that's an important point. I mean, I think a lot of investors have it as a criterion, honestly. Someone's just asked about the M&A approach more specifically. I mean, are these deals, are there cost synergies, or is it mostly on the top line for growth? Or what's sort of the ideal acquisition target as you grow in the next couple of years?
The synergies across our present portfolio are really ones of overall technical operational project development oversight, which we have a lot of experience and skills of, market engagement oversight with all value add in terms of counterparties, off-takers, trading partners, obviously political risk management and funding support, both from TechMet, where we're busy funding with equity to build dominant positions, but also in parallel securing and structuring of debt at the project level as we continue to scale. And I think those synergies, or at least those value add from the TechMet holding company level, are ones that will continue across any additions to our portfolio. In some instances, obviously, there are operational synergies and cost savings that we can derive from projects that are adjacent or are related to our existing portfolio, like the mining company we're hoping to merge with in Rwanda. But in other instances, it's simply a global platform that adds value from the TechMet level, despite the diversity of industries and geographies that we're investing in and building dominant positions in.
Brian, someone's asked about your exit strategy here, and you don't have to answer this in too much detail if you don't want, but when you look at some of the large companies that you mentioned that are only operating at a pretty small level in some of these technology metals, would they conceivably try to grow into that area organically, or try to acquire a company like TechMet? What do you see these big guys doing if they want to get exposure?
Yeah, I mean, the big miners, certainly when they want to get exposure to our metals, which I think they will, because as I mentioned, this is going to be the biggest mining and natural resource or metal boom of our generation. They will have to try and buy somebody like us who's done the hard work of creating $1 billion of value over a number of years, and therefore creating the critical mass that justifies their time and attention. Because if you're Rio Tinto or BHP, you need to deploy $1 billion in a new space in order for it to be worthy of the effort and the time and the exposure and management time at the senior level. So I think that's right. And likewise, big private equity, who are increasingly aware of this space, likewise need the critical mass. So from an exit strategy point of view as TechMet, or at least not exit, because I personally, as the biggest shareholder, don't want an exit, but from a point of view of creating liquidity for our shareholders, which we have undertaken to do and will do, Our range of options range from a 4 to 5 year time horizon to $1 billion plus IPO as we build our present portfolio and hopefully add to it, to IPO spin-off, sale of underlying operating companies and distribution of value through TechMet as a result of those transactions. So we're flexible with respect to how we do that, but we certainly will do that and continue to explore those opportunities to create liquidity and release value for our shareholders over the next 2, 3, 4, 5 years.
Great. And a question about leverage. As your cash flow begins to appear, is this business well suited for leverage to use for expansion, or do you need to rely mainly on equity?
It is. We've got very little debt at the TechMet level. We've got very little debt at the operating company level at the present time as well. There are certain elements of our portfolio which we will secure substantial debt to further expand and scale, such as our nickel cobalt project in Brazil. So our ongoing expansion of these operations will be a combination between TechMet equity to continue to build our dominant position, and debt at the project level. We don't have any plans for any significant debt raising at the TechMet level, though obviously as we continue to grow cash flows that come through to TechMet, as we will over the next 1-2 years, there is that option further down the line.
Okay, great. Someone is asking about the car makers, the manufacturers, changing their approach to battery components. Is there a concern that some of these manufacturers, and the persons as mentioned BMW, will try to reduce dependence on technology metals? Are there other ways for them to create these batteries, and is that factored into your forecasts?
It is, and we've done a lot of work on the evolution of lithium-ion batteries, as well as on alternatives, alternative power sources for clean mobility. So lithium-ion batteries themselves are obviously continue to evolve and continue to become cheaper and more efficient. And one of the things that battery manufacturers are doing and will continue to do is the thrifting of cobalt to reduce cobalt content in the cathodes. And there certainly will be success in that to an extent. And we certainly in our models assume that the 20% plus or minus average cobalt content in cathodes today will reduce to somewhere of the order of 5% over the next 5 years, and that's factored into our supply-demand models. However, we do believe that lithium-ion batteries with approximately the present configuration and chemistry will dominate, certainly for automotive, for the next 10 to 12 years. The alternatives, solid-state battery cells, will be relevant, may well come to be a significant portion of the clean electric vehicle power source picture in the future, but they use most of our same metals. They just use more lithium because generally they have a lithium anode instead of a graphite anode. So that doesn't significantly change the supply-demand equation. Other alternatives that will reduce the usage of lithium-ion batteries, which has massive incumbency. I mentioned the billions and billions of dollars going into lithium-ion battery technology manufacturing capacity today, the commitment of all the big global automakers to electric vehicle fleet with lithium-ion batteries, very difficult to dislodge as they become cheaper and more efficient every day as a result of economies of scale. However, solid-state batteries may play a role, but need the same stuff we produce. The only other one that is real are hydrogen fuel cells, which are in existence, do work, and in our view will play somewhat of a relevant role in buses and trucks, commercial fleets, but are unlikely to in passenger vehicles as a result of the cost and safety issues associated with the infrastructure for delivery of hydrogen. And hydrogen fuel cell vehicles are essentially hybrid vehicles with lithium-ion batteries. They just have smaller lithium-ion batteries. So we are really not worried with respect to alternative competing technologies substantially altering the demand landscape for our metals. However, because it will change, we are investing in building across the full range of technology metals. We're not just dependent on cobalt, lithium, nickel. And therefore, we are flexible and able to continue to tailor our investment program to produce what we're confident will be in greatest short supply in 3 years, 5 years, 10 years time. And it's one of the reasons we've got Professor Vasant Kumar on our advisory board and others, and continue to do a lot of work on battery R&D, or at least becoming, remaining aware of battery R&D and system and technology evolution to ensure we're producing the right materials, medium term and long term.
Great. Brian, someone's asked about this ESG point again. Some mines have unfortunate histories of being big polluters. Are you able to extract these metals and create the final product you're delivering to clients in a clean way?
We certainly are, and we're very dedicated to that. Mining can be an offensive, dirty business, and it can be a very sustainable, environmentally and socially constructive and responsible business. It's a matter of how you do it. Our mine, for instance, in Brazil, the nickel cobalt producer, which we'll be developing the first commercial plant on over the next 12 months, is designed to be extremely energy efficient, designed to produce most of its own energy, and to have a very, very small and manageable and repairable environmental footprint. And that's possible across all of our projects, and we will continue to do everything we can to be extremely clean, sustainable, and responsible in all of our operations. Just because mining has some problems in its history doesn't mean that mining needs to in any way be an offensive industry from an environmental impact or social impact or political interface point of view. It can be responsible, and we are and will continue to become more and more responsible as we develop.
Good. Someone has asked about barriers to entry. So the company has a head start with 5 assets already, perhaps more soon. Is there a concern that someone else could come and buy up similar assets and compete with you very quickly, or does that head start give you a lot of protection?
It does to an extent. I mean, we are 15, 20 years behind the Chinese. So, it's not like we're somehow alone doing something nobody else had thought of. It was thought of a while ago. And it's a fairly obvious space. I mean, it's so compelling that the view of this market supply-demand dislocation is obviously not unique to us, and the space will become more crowded and other people will start to do more of what we're doing. And we're not in any way scared of that. We have unique expertise, we have great deal flow, we have extremely strong portfolio and technical teams, and there's space for 20 TechMets in the market. So it's not really a concern for us in terms of our scalability and the quantum of value we can create for our shareholders.
Great. When you look at the pipeline of potential clients, Brian, do you think it's likely that you'll have a diverse set of purchasers who need these metals? Are there plenty out there that's possible that you could have a dozen or so major clients, or how does that shape up?
No, there's a very significant diversity of off-takers for everything we're producing in Europe, United States, and Japan. Particularly Korea, obviously, is a very important user of a lot of these materials, as increasingly will India be as they develop in these industries. So there's no problem with demand and diversity of demand for everything we produce or everything that we're going to produce. There's one area that is highly problematic, and that is production of rare earth concentrates, which we have an interest in a company that produces in Burundi. And at the present moment, there's no choice other than to sell those concentrates to the Chinese because they have an overwhelmingly dominant position with respect to rare earth metal processing. And that's something we are busy scoping how to remedy by developing processing capacity in the US to provide alternatives for non-Chinese control feeds of rare earth metals out of Africa, out of North and South America, that at the moment have nowhere else to go other than China, who controls the value-added products and captures 80% of the value, leaving very little for producers who in most instances are therefore pretty marginal.
Okay, great. Well, Brian, we've gone through all the questions, and I think you've been quite thorough. Unless there's anything else you wanted to touch on, I think we can wrap up now.
No, that's excellent, John. Thank you so much. Obviously, we're very, very We're particularly keen to grow our shareholder base in the US, given our US strategic alignment, given the fact we're building lithium-ion battery recycling capacity in Rochester and hopefully next step in the West, because we have a very growing position in vanadium specialty chemicals plant in Arkansas, and because we're obviously engaged with US government agencies to leverage our geopolitical positioning into support to grow bigger, quicker. So US shareholding coming in now in round 2 is a big strategic priority of ours, not just because any money is nice, but because the greater the level of US involvement, the more we consolidate and solidify our US alignment strategically. So obviously any of those who are listening into the call who are interested in participating in what is a very, very compelling value level, will raise our price significantly beyond our closure with DFC in Washington. At the moment, we're still raising at a price where our very de-risked conservative base case models give a 7 times uplift in value over a 5-year time horizon, which is, a very, very compelling with flat metal prices and very conservative project assumptions. So anybody who has appetite to participate, it would be a great pleasure if you email us at henry.finnegan@techmet.ie to engage with you directly, send you detailed materials and answer any further questions or detailed queries that you have.
Great. And just one last reminder, we will publish a replay of today's webinar later this afternoon for people who couldn't watch the whole thing. And if anyone wants any more detailed materials, please just reach out to us at editor@ipo-edge.com. We can provide individual slides and so on. Thank you so much, Brian. This has been great, and we really appreciate you joining us.
Excellent, John. Thank you very much.